All right, good morning, everyone. Hope everyone is well. We are going to get started right on time because there's a lot of material to cover. Had to take my jacket off, roll up my sleeves because tax is a big topic. And we can't cover everything in real detail, but we're going to cover it as well as we can, some broad general principles. And of course, we're available to talk to you at any given point in time. So there's myself, Derek Dutka, and my associate, my partner in business here, Chelsea Chartrand, who will now introduce us, get over some housekeeping things, and we will carry on with tax tips and tricks for the year end.
Wonderful. Thanks, Derek. So before we get into the agenda, there are just a few items to keep in mind throughout the presentation. Number one is please keep yourself muted during the webinar with your cameras off. We are going to be recording the presentation and posting it to our YouTube page. So for whatever reason you have to jump off, you can catch the replay later. And at the end of the webinar, you'll have the opportunity to ask questions through the chat box on Zoom. So if you think of anything while we're going through the material today, just type them into the chat box and we will get to those at the end. So let's look at the agenda for today. We're going to start off by briefly discussing Canada's tax system and how it works. Specifically in Ontario, I know there is one or two people here joining from out of province. So just keep in mind while we're going through these things, they are as to the Ontario taxes. Then we'll walk through the 4 Ds of tax planning, our personalized year-end tax optimization process that we run through with each of our clients. And then we'll finish off with some important tax changes for 2025. As we know, the budget was released recently, so we'll go through some changes that are proposed through there. Derek, can you start us off with going through Canada's tax system?
All right, Canada's tax system, as you may be aware, is a volunteer system that started in the First World War to be a temporary voluntary tax to help fund the war. I guess there's always a war going on somewhere, so they've kept the system in place. It's called a progressive tax system. And not sure if you understand what the government means by progressive, but it simply means the more you make, the more you pay. And so everything is divided up into tax brackets. There's a different one for each province and a different one for the federal government. So we'll take a look at the federal tax brackets and the Ontario tax brackets. Each province has its own, but they're similar. So the 2025 federal tax rates, and there's been some adjustments in the budget so that the first $57,000 will actually drop down to 14.5% for 2025 and 14% for future years. However, as we cover at the end, the budget hasn't been passed and written into law because oftentimes, even though the budget may pass, they will make adjustments before they finalize it. So until that happens, everything is just a proposal. But you can see that as your income increases, the marginal tax rate increases. And when you're making a lot of money, you pay a lot of taxes. So we'll carry on to the next, and Chelsea will talk about how you calculate your taxes.
Okay. So as Derek mentioned, we're going to review the basic formula for how your taxes are calculated. And there's 4 main categories that you'll notice when you go through your return. So it starts with total income. And then there are some deductions from your total income that equal net income. Things like RSP contributions or carrying charges or even pension splitting amounts. These are examples of things that are deducted off of your total income to get to net income. And then to reach your taxable income, there are additional deductions that are taken off, such as capital gains deductions or like net capital losses from previous years, for example. And then finally, to reach your tax payable, you multiply your taxable income by your average tax rate. Now your tax payable and your actual tax due or tax refund on filing typically don't equal each other because there are tax credits that reduce your tax payable. And we will get to the explanation of tax deductions and tax credits shortly. So that's just a general overview of the three main incomes. So total income drops to net income and then eventually gets down to taxable income. Oh, sorry, missed that slide there. Okay, so now you might be wondering why there are certain deductions to reach net income and then there's other deductions to reach taxable income. So here are some of the reasons why the government needs to differentiate them. And the most important one is that net income is very common to be used to determine eligibility for certain income tested benefits. So if you're receiving old age security, that's one of the items that is based off of net income, and it is income tested. Some incomes, while they're not taxable, they are considered when applying for social benefits. So for example, if you were injured at work and you're receiving workers' compensation, this is an example of a non-taxable benefit, but it is still included on your net income. And because it's included on your net income, it would affect your old age security eligibility, but it won't be included in your taxable income as there's an offsetting deduction. So there's a few things to keep in mind while you're working through your incomes and what's affecting your eligibility for certain resources. And before we get to the next slide, I'm just going to dive into the old age security clawback briefly. The government starts taking back a portion of your old age security for every dollar that's over $93,454 for 2025. That threshold does increase each year with inflation. And for every $1 over that number, your old age security pension is reduced by 15 cents. The amount of your clawback is based on your previous year's tax return. So for example, if your 2025 net income is $100,000, your old age security will start to be clawed back in July of 2026. The maximum old age security pension as of January 2025 is $8,820 a year. And you would have had approximately $1,050 clawed back if your net income was $100,000. The last bullet point on the slide here is there is also max income thresholds. So depending on your age, if your net income crosses over either of these numbers, that results in 100% clawback. Derek, can you walk us through marginal and average tax rates?
But first, we like to have a little fun with our clients, and we tell them that our goal is to make sure that both of them get their entire old age security clawed back and they don't receive any. Now, they find that a little shocking, but we say if you can't get by on $300,000 a year, you have a different kind of problem. So it is a clawback, but most people that are affected by the clawback aren't concerned about drawing welfare or something. It's just that it's an income that they feel that they've been promised all their life, and so they would like to have it. And so we do the best we can to help people keep under that clawback limit. So marginal average tax rates. Marginal tax rates, if you remember back from the previous slide, we talked about if you have a certain amount of income, then you pay a certain amount of tax. And as you move into a higher income bracket, you pay more tax. So that's your marginal tax rate. So for example, if I made $60,000, I'm in the second tax bracket, federal tax bracket, and that any extra $1,000 or any extra dollar I earn, I would pay that higher rate of tax. Now, the average tax rate, as Chelsea says, once you get down to taxable income, how much tax do you pay on the total amount of income that you have? That's your average. So we'll walk through this with an example of a young fellow making some money, a single 35-year-old making $75,000 in salary. And so let's walk through the tax rates in Ontario.
Yes, awesome. So yes, we have Brian who has $75,000 of employment income. So let's walk through this chart together, starting on the left-hand side. So it shows the these are the combined Ontario and federal tax rates and what income falls between each tax rate. So as you can see, up till $16,129, the tax rate is 0. There is a basic federal exemption up to $16,000. And then you can see, each income threshold thereafter, and then the associated tax rate. We then move to the income within the bracket. So it just breaks down on this column here, the income within the bracket, which totals $75,000. And then what tax is payable within each of those brackets. So the bottom right-hand side, $13,857 is the actual tax that is payable on his $75,000 income. And while you can see his marginal tax rate is 29.65%, his average tax rate is actually only 18.5%. And there are a number of ways that you can minimize your taxes. And the most common method is by using tax deductions, which we'll get into shortly. Derek, anything to add?
Oh, just again, the average. So if Brian earned an extra $1,000, his marginal tax bracket is he would pay basically $300 in income tax, but his average tax rate would only go up by a fraction of a percent. He'd still be under 19% as the average tax rate on 76,000. So let's move into how different types of income get taxed. And so this is sort of like the progressive system. There's a progressive system of taxation depending on the type of income that you earn. And so we're going to take a look at these and we'll consider these things. We'll start from the right to the left. Whoops, go back to that slide.
Right.
So the highest form of tax is salary or interest income because basically everything is considered taxable. So that's the highest, most tax that you would pay. So these little bundles of loonies represent how much tax you'd pay out of every dollar you earn. So now we can flip on to the next slide and we'll actually follow through it with numbers. If you earn $75,000 of employment income, and we're assuming no credits, no deductions, this is just, basic credits, no deductions, $75,000 is your taxable income from employment, you would pay $1,857 in taxes. If you earn interest or foreign dividends are treated the same as interest. 100% of it shows up as taxable income. So it's the same as going to work, just that you don't get any benefit of no regular paycheck. You just get whatever comes in from there. You would end up paying exactly the same amount of tax. Now, this is if it's all Canadian interest. Foreign dividends are considered the same as fully taxable, but if you have foreign dividends, you own some foreign stocks, typically there's some withholding tax held in the foreign country, and you would get a foreign tax credit, a proportion of that back, so you pay a little bit less tax on foreign taxes. But we're keeping things simple here. Basically the point is if you're earning interest or foreign dividends, your taxable income is exactly the same as if you go to work. Now, eligible dividends, so these are dividends from RBC, from Bell Canada, from any Canadian corporation that pays out a regular dividend, and they have what they call a gross up. So even though you'd only receive $75,000 worth of income, you'd have to report on your tax return $103,500. Now, where this is important is for those people that are over age 65, they would have some of their old age security clawed back, not because they received over $75,000, but because dividends get grossed up and they actually have to report for tax purposes that they have $103,500 worth of taxable income. Even though, if you look at the right-hand side, they only pay $2,122 in actual income tax. That's because there's a dividend tax credit. Now, this is assuming that there's no other income of any sort, no old age security, no CPP, no pensions, just straight dividends, because you've got your personal exemption, you've got the dividend tax credit, which eliminates much of the taxes on that $75,000. Non-eligible dividends, they're from private Canadian corporations. So if you own your own company and you pay yourself a dividend, those are considered non-eligible. You have a smaller gross up, that $75,000 would only have to be increased to $86,250 for tax purposes, but you would owe a lot more tax. You'd owe $9,062 in income tax because you don't get the same kind of tax credit on that. Capital gains, you only have to report half of your capital gains. So you'd only report $37,500, even though you got $75,000 in your bank account. And of course, tax due on that would be $5,380. So again, it's favorable. Now, one other investment type of income, typically from real estate, more from real estate properties. They can pay return of capital. There are also some mutual funds that pay return of capital. What they do is they say, we're giving you this money, but it's actually, we're giving you your capital back. It's not interest or dividends or capital gains. We're returning your capital. You pay no tax on that, even though you got $75,000 in your bank account. There will be the piper to pay at the end of the day, because if they're returning capital, then they're decreasing your cost base and you'll end up owing taxes down the road. But that's a little more detailed than we can cover today. So let's carry on and we'll go through the
4Ds.
4D.
Okay.
Chelsea was talking about. I should really do this because I've got 2 Ds in my name. You have 2 Cs, but you go ahead and do the 4 Ds.
Well, I'll start us off and then maybe you can join in. So the 4Ds of tax planning are deduct, divide, defer, and diminish. Tax planning strategies generally fall under these 4 categories. You can deduct taxes, defer taxes, divide taxes between 2 or more parties, and diminish taxes. So let's start off with tax deductions. Like we talked about earlier, deductions reduce your taxable income. Strategically contributing to RSPs is a great example of how to use tax deductions. Another example is if you have an open investment account, like a non-registered or taxable investment account, certain advisory fees are also deductible on your taxes. Maximizing rental expenses. If you are renting out a portion or an entire rental property, any expenses incurred to operate the rental can be deducted against the rental income. Keep in mind that there are rules on these, so we always suggest to consult a tax professional before proceeding with anything. Also, some childcare expenses are a tax deduction as well. Eligible expenses might be costs for daycare services, day or overnight camps or sports for schools. But we do warn on this because not all childcare expenses are tax deductible. So again, please consult with a tax professional. So those are some examples of tax deductions. And now Derek will lead us through tax credits.
All right, taxes reduce your tax payable. The tax savings are based on the lowest. So whereas an RSP deduction, if you're in the 40% tax bracket, you get 40% savings. A tax credit is only at the lowest. The 15% is the federal lowest, soon to be 14.5 and 14. So there are things like refundable and non-refundable credits. Everybody's allowed a basic personal exemption. There's an age credit for those people that are over age 65. If you're receiving pension income, either from a company pension or from your own RIF, if you're over age 65, you get a $2,000 a year credit, and there's a Canada's workers benefit. Most of those are non-refundable, which basically means that, hey, it can refund any tax that you paid, but you're not going to get any cash from the government if you didn't pay them any taxes. A refundable credit is, even if you don't owe taxes, you will still get that money back as a refund. So let's take a look through we're talking especially about seniors and tax credits that would affect seniors, because we do have a few seniors in our client base. So if we can go to the next slide. This is, again, in Ontario. Each province is similar, but the numbers might be a little bit different. So each person is allowed a basic personal exemption of $16,129. So if you're married, between the two of you, you could actually earn $32,258, and your basic personal exemption would eliminate any tax owing on that. In addition, if you're over age 65, depending on your income, which we'll talk about in a minute, you could get an additional age credit. See, there's some benefits of getting older. You could claim $9,028 as the age credit. And if you're both over 65, that's a total of $18,000. And if you're receiving, again, over age 65, receiving RIF income, or under age 65 and receiving pension from a company pension, each of you could claim $2,000 as a pension credit. So a total of $27,000 as an individual, or $54,000 as a couple. So if you were able to split your incomes evenly, even if one person had a big pension, you can split pensions. We'll talk about that later, up to 50%. If you can get your two incomes to $27,000 each, that means your family could have $54,000 of income and you would pay zero income tax. So that's not too bad to start things. Now, to fully claim the age and the pension, or not the pension, but the age credits, there are certain thresholds, and so that will be shown on the next slide. Or sorry, not the Ontario Health Premium. Yes, there.
Derek mentioned that you would pay zero tax, but there is an Ontario Health Premium. So if you live in Ontario, while you might pay zero income tax, there is still a certain amount that goes to the Ontario Health Premium. And it depends on your taxable income. So again, the more you make, the more you pay. But this kind of gives you an idea of where essentially you would fall and how much you would pay depending on your taxable income. And it is also per person as well. Okay, so now Derek, I'll let you explain the age credit and how it is income tested also.
Okay, so as with everything else, they talk about all these things, but they like to sort of quietly diminish them over time, or in this case, over money. So the federal age credit, if you have more than $45,500 worth of income, it starts to disappear and you get less and less of that credit. So although you can be over 65 and avoid the old age security clawback, which is about $93,000 of income, you would lose most of that age credit because you've got from 45,000 up to say $90,000 of income, you lose most of that age credit, so you end up paying a little bit more tax. The Ontario age credit, again, very similar. It starts at 46,000 and disappears at 87,000. So again, they give and they take back. So that's how the age credit gets phased out. And Chelsea's going to talk about a few other credits and deductions.
Yeah, so here's a list of some other ones that might apply to you. Some are applicable to only ages 65 and up, and some are applicable to everybody. So let's start with the disability tax credit, and this is applicable to any age if you are disabled. There is an application process that goes into this, so essentially you have to complete a form in conjunction with having it signed by your doctor, and then submitting it to the CRA for approval. And if you are approved, that tax credit is just under $9,500 every year that you're approved. Then there are medical expenses. So any amount that's over 3% of your income, you can claim on your tax return as a credit. Then we have the home accessibility tax credit. It's a non-refundable credit for eligible renovations that are made to your principal residence to improve safety and accessibility for a senior or a person with a disability. This one's quite a big one. If you are able to utilize it, you can claim up to $20,000 in eligible expenses per year, which results in a maximum tax credit of $3,000. Then there's the Canada Caregiver Credit. If you support a spouse, a common law partner, or a dependent with an impairment, you may be able to claim this non-refundable credit. However, it is income tested, and you can only claim it if the net annual income of the dependent, so not you, but the net annual income of the dependent is between $8,000 and $28,000 for 2025. So if that dependent's income is over $28,000, you will not be able to claim the Canada Caregiver Credit. We also have the Ontario Senior Homeowners Property Tax Grant. So as you can see in the name, it is for seniors, so only ages 64 and up. Refundable grant of up to $500 for seniors. And you also have to have a low to moderate income and pay property taxes. So as an individual, if your net income is between $35,000 to $50,000, you can claim a portion of this tax credit. Or if you're a couple, your net income has to be between $45,000 to $60,000 to be able to claim all or a portion of this tax credit. And then lastly, one that you might not really be aware of is the Ontario Seniors Public Transit Tax Credit. So again, you have to be 65 or older. You can claim up to $3,000 in eligible public transit costs annually. So those are just a few others that you might not have heard of that we'd like to make you aware of.
Just as we move into dividing, this actually works out very well. The medical expenses, 3% of your net income, or for 2025, it's an amount that's above $2,833. So if you got a high income, 3%, let's say you've got $100,000 income, 3% is $3,000. Well, no, that's not true. It's the lesser of 3% or $2,833. So if you had $3,000 worth of medical expenses, you'd still be able to claim about $1,200. However, when we come to income splitting, what we often see is that both incomes aren't exactly the same, or even though you try to get it ideally the same, that's not always the best for you, because if you've got medical expenses, if you have one spouse that only has a $20,000 taxable income, then they only need $600 to start qualifying for the medical credit. So again, there's little things like this that tax software or your accounting professionals will help you with that. But we're going to talk about dividing. So the next D. Dividing is basically splitting income. And typically you can do that, as we talked about. Pension splitting is one of the greatest things since sliced bread, as far as we're concerned, from financial planners. It allows you to split pension income up to 50% to either spouse. And again, if it's regular pension from a corporation, then you can split that at any age. If it's from an RSP that you've converted to a RIF, you have to be at least 65 and it has to come out of a RIF before you can do that splitting. But that's wonderful because, with some of the clients, especially that are already in that tax bracket or in that age bracket, they may have come from the time when one spouse stayed at home and didn't have much of a pension, and the other person has either large RSPs or a good pension. This allows them to take, for example, if you had $100,000 worth of pension and RIF income, you can now claim that $50,000 each, and so on. So pension splitting is one of the big things that we use, especially with clients with RSPs that we're able to convert to a RIF at age 65. That really helps. If you're joint owners on a taxable investment account or even your bank account, you're allowed to split the income on that. There are some things that get into a little bit more technical. You can have prescribed rate loans. You can loan money to a family member, and CRA issues a specific rate of interest that you must charge and report on your income tax. But then the other individuals in your family can invest that money, and they would claim the tax, or they would claim the income on their income tax. That avoids what they call attribution, because if you just give money to a family member and have them invested because they're in a lower tax bracket, CRA considers that tax evasion and you could go to jail for that. So, but if you do, quote, loan them the money and charge the prescribed rate of interest, hopefully they will earn more, and all that money can be earned by them. You still have to pay tax on the interest that you're prescribing the rate to. You can gift capital to minors, but again, you have to be careful about attribution. You can gift any amount to adult children, but remember, if it's a gift, you are giving it to them, you no longer have any control over it, and you may have to pay tax on the money that you have in order to gift it. If you got money in stocks or mutual funds in a taxable account and want to get that to them, again, you'll have to pay tax on any capital gains. If you have your own business, you can have family work in the business, but they've tightened up the rules on that. They actually have to have a reasonable salary paid for them. If they're as a shareholder, they have to have had something that they put into the company to be qualified for that. Otherwise, they can just quash all that and say that doesn't count. You can gift money to your spouse for tax-free savings account. Well, you can actually gift money to your children, but you can't put it directly into their TFSA. You have to gift it to them. They have to put it in their own bank account and then contribute to their own TFSA. You can transfer capital losses on occasion, or you can trigger superficial losses. And that gets into a bit of a technical thing, but there are a few ways that if you have situations where you've lost money or your investment is down, it might be worth triggering a loss to help offset some capital gains you have in something else and to repurchase that later on. Okay, so that's dividing. Next D, Chelsea.
Yes, so the next D is deferral. So how can we defer your taxes? As I mentioned earlier, RSPs provide a tax deduction for contributions, allowing you to defer the tax on those funds until you withdraw them. And typically when you make an RSP contribution, it's when you're earning a higher income. So typically we recommend income over $60,000 is when it makes sense to start contributing to a TFSA. And then down the road, once you're retired, you would then start withdrawing from your RSPs, hopefully with an income less than $60,000 to be able to take care or take full advantage of that tax deduction. A more complex strategy, which depends on the person, is a vendor take-back mortgage. And this is essentially if you have a cottage or like a rental property or something that you're looking to transfer to another party. It allows you to spread out the capital gain from selling that investment over multiple years. So instead of selling the cottage and claiming the full capital gain in 1 year, you can spread out the capital gain over 5 years. And we've used this strategy with many of our clients that are looking to sell their cottage to their children. So, for example, say there's a $250,000 capital gain on your cottage. With the vendor take back mortgage strategy, you would be able to spread the gain out at $50,000 gross, so $25,000 taxable capital gain per year over the next 5 years. So you can see that would provide a significant tax savings versus claiming the lump sum of $250,000 or $125,000 taxable. And that would likely push you into the highest or higher tax bracket and maybe some old age security clawback if you are receiving old age. Anything to add on that, Derek?
Well, that's a good point. As Chelsea mentioned, people with up to about $60,000 of income, we tell them just put it into your tax-free savings account. And as you increase your income later on, we can move from your tax-free savings account into your RSP, where you'll get a greater tax deduction. I had a client, this was back a few years ago, and the lowest tax bracket was a little bit lower. He owned a business, and of course, there were things covered by the business, expenses that he didn't pay. He was contributing to his RSPs. It took me a couple of years to convince him to stop putting money into his RSPs. He says, "Why? The accountant's been after me all these years." And I said, "Well, you've done a really good job of that, and now your RSPs are very large. And even if you don't contribute anymore, based on how they're growing, by the time you retire, your RSPs are going to push you into a higher tax bracket than you are right now, because with company, you're taking a low amount of salary, but you get other benefits. So you're actually paying less tax now. Why would you put money into an RSP and save 20 cents on the dollar when you pull it out of that RIF later on, you're going to be paying 30 or 35% tax. So again, that's part of the tax deferral. It has to make sense. And as Chelsea said, we've used the deferral with cottage capital gains, especially, and most often it's done when you're passing it on to a family member, whether you ever intend to go and collect on the vendor take back or not, or it's just a gift, but it's a way of spreading taxes out. And we've been able to help clients do that in a number of occasions and keep their incomes below the clawback level. Which sort of leads into the next D, the final D, diminishing taxable income. Well, how do you diminish taxable income? First thing you do is you put as much as you can into any kind of tax sheltered accounts. So make sure that your tax-free savings accounts are maximized. You could have contributed up to $102,000 as of January 1st of 2025. Next year, we'll be able to add another $7,000 into that. It's assuming you have been you were age 18 when they first brought in the tax-free limits, because it's based, you have to be at least age 18 to start one. But all that money inside your tax-free savings account is no longer in your taxable account. If you make a contribution to your RSP, it's no longer in that. So we've had situations where each year we're taking money out of people's open investment accounts that are taxable. And rather than having them contribute money, especially if they're into their retirement years, say, don't take money out of your bank account. Let's move money from your jointly held investment account that you have to pay tax on the interest and the dividends. We'll move it over into your tax-free savings account with our ultimate goal of building up the tax-free savings account to be the largest accounts. If you need to spend any money or withdraw any money, take it first from your open account, your taxable account, because that's decreasing the amount of investments you have, which means you'll earn less dividends, less interest, and less capital gains going forward. So you're diminishing the amount in the open account and you're increasing the amount in your tax-free accounts. There are a few situations. There are some mutual funds that have a corporate class structure. And what that means is instead of a mutual fund trust, which passes along interest, dividends, and capital gains as they receive them, a corporation can't pay interest. It can only pay can only pay dividends or capital gains. So any kind of interest income gets reclassified as dividends or capital gains. And as we saw from the earlier tax slides, capital gains and dividends are taxed at a much lower rate than regular interest income. So again, this is a way of diminishing the taxable income. If you're incorporated, if you have your own business, there's a choice. You can pay yourself salary or you can pay yourself dividends. And again, we saw earlier, there's a difference. You get some favorable benefits by paying yourself dividends. Have to be careful though, because if you pay yourself all dividends, you end up with no CPP contributions, you end up with no RSP limits. And so unless you're saving significantly more above that in some other form, you could be in for a shock when you hit 65 and want to get your CPP because you'll have zero because you haven't contributed to it. And you also may have no RSPs, which in a sense isn't bad because you don't have RSPs when they become RIFs. That's fully taxable income. But if you haven't built up huge amounts of savings somewhere else, then you're going to be in trouble because you won't have enough money. Yeah, those are the key ways of diminishing. One other way, I guess, is many people make charitable donations, whether that be to a hospital foundation, to a religious organization, whatever. Giving money is a great way of diminishing your open assets, and especially, and we'll get into specific examples later on, if you have stocks or mutual funds that have large capital gains in your taxable account, when you gift the shares directly to the charity, and there's ways of doing that even if they're a small charity. There's a organization like Canada Helps and WealthLink, I think it's called, that allow you to give directly to a charity. And CRA says, oh, you're giving your stocks or mutual funds to a charity. That's wonderful. We're not going to tax you on the capital gains. So you avoid legally avoid the capital gains on that. The charity cashes them in. They don't have to pay tax on capital gains. So it's a way of you getting the same tax benefit of the charitable donation, but you're eliminating your taxable capital gains. So that diminishes your taxable income. And that leads right into charitable donations, which Chelsea will take us through.
Yeah, so we'll just walk through a few general details on the tax credits depending on the amount. So as you can see here on the slide, the first $200 of donation receives the smallest federal tax credit of 15%, or soon to be 14.5% if the bill passes. However, donations over $200 receive a 29% federal tax credit. And if your income is over $253,000, you can receive a 33% federal tax credit for some of your donation. Now, as the government always does, they have set a limit on how many donations you can claim each year, and that limit is 75% of your income. So if you're making $100,000, you can only claim up to $75,000 of donations. Just giving you a visual here again of the amounts and the federal and provincial tax credits. Speaking of Ontario in this case, so again, any amounts under $200, you'll receive up to a just over 20% tax credit. And then amounts over $200, depending on your income. So if your income is under $253,000 for 2025, you can receive up to a 40% tax credit. And if you are earning more than $253,000, then you can earn, you can earn a 44% tax credit. So a lot of tax savings to be made through donations. And if you aren't able to make RSP contributions anymore, this is the second best way to save taxes.
All right, so let's look at an actual amount of giving cash versus appreciated securities. Sometimes we have people call us and say, oh, can you send us, $5,000? We want to donate to this or that cause. And well, just a minute. Why don't you tell us who you want to give it to? We'll see if we can find if they've got a securities account, or if we can go through Canada Helps or one of the other organizations. Because if we send you the money, that means we trigger a capital gain. So we're going to use an example here of the highest tax bracket. But even if you're in a low tax bracket, the worst you're going to end up with is about 40% when you combine the federal and provincial tax credits. When you're in a very high income bracket, you can get basically almost 50% of it back. So if the original cost of your investment was $20,000, current market value is $100,000, and you've got a capital gain of $80,000. So if this individual wanted to gift $100,000, they'll send me $100,000. I'm sending it to the Cancer Society or Sick Kids Foundation. What would you actually have to pay in tax? Well, that would show up $40,000 of taxable income. If you're in the top tax bracket, you're going to pay half of that to taxes. So $20,000 of tax. You're going to actually give credits, or the donation amount after taxes is only $80,000. And your credits, okay, sorry. I was going down, I'm going across.
That's
So
okay.
if you gift the securities directly to the charity, you don't report any of the capital gains. The charity still gets the $100,000, and you get a receipt for the full amount that you've given them, which is the $100,000 worth of shares. In the case of us selling the securities to send the money to you, we would advise you, well, you're going to have a $20,000 tax liability, so we better hold back $20,000 to make sure you can pay your taxes. You only have $80,000 to give to the charity. So the charity ends up getting less, you get less of a tax savings. Whereas if you donate the securities directly, you pay zero capital gains tax on that capital gain, but you get the full benefit of the tax credit of the $100,000. You end up with more tax savings. And just one example that we did for this, again, there's special situations. It doesn't happen every year, but we had a situation where a client had been talking about doing this. They were quite well off, had a good pension and so on, about gifting some money to their children. The husband passed away quite unexpectedly. So we carried on with this planning after he passed away with the spouse. And yes, she still wanted to go ahead with it. The financial plan was fine. They had lots. But because they'd had quite a large amount of investments, there was significant capital gains. Now, normally they gave some money to charity each year. So in this particular instance, we suggested that if they made $100,000 donation that year, that would basically wipe out all the taxes on the capital gains from the money they'd given to their children. And so what we did with this is we opened up what's called a donor advised fund. They put the $100,000 into this, basically a private foundation run under the umbrella of a larger charity, benefaction foundation. And they get the whole tax receipt this year. And now what we're doing is we're distributing it. We basically prepaid their next 5 or 10 years worth of donations in this 1 year when they had real high income. Now, going in the future, they don't have to take money out of their bank account or from their investments to make the charities. They're just going to use that $100,000 we put in this donor advised fund to give out to charities. They'll get no further tax receipts, but they don't need the tax receipts as much in future years because they don't have as high of income. Anything I missed on there, Chelsea?
No, I think you covered that well. Thank you.
Okay.
Okay, so we'll be moving to the next section of our webinar today, and that's our year-end tax optimization process with some considerations. So on a typical, I guess in the fall with each client, we review your previous tax returns, your estimated income and deductions, and we create a projection of your expected taxable income for this year. We then review your financial plan and goals to assess your cash flow needs. Are there any large expenses on the horizon? Do we have enough tax efficient cash to fund them? And then next, we identify your optimal level of taxable income required to fund your goals. We then move forward to annualize your tax liabilities and potential sources of taxable income. And we do confer with your accountant also where it's needed. And then at the end, we finalize our projections with our recommended actions. We'll be walking through an example next. So if that sounded like a lot, we will break it down for you. But just some things that we typically look and do each year with our clients is withdrawing additional amounts from a RIF, a LIF, an RSP. We might look at triggering some unrealized capital gains to bring taxable incomes to the top end of the next tax bracket. Usually this involves paying a little bit more tax now, but it significantly saves tax over the long run. It can also involve additional RSP contributions. So for example, if your taxable income is $65,000, we might recommend making a $5,000 to $10,000 RSP contribution to bring your taxable income into the lowest tax bracket. So let's look at a real life example on the next page here. So it says 2024, but tax year is irrelevant. We look at these every year. So we see two different scenarios here. Scenario one is with current income and no additional tax minimization strategies. And scenario two on the right shows a lump sum withdrawal amount out of a RIF. And this strategy brings the couple's taxable income up to, but not over, the old age security clawback limit. So you can see at the bottom right-hand side of the screen, their taxable incomes are about $86,000 each, which is well under the 2025 clawback limit of $93,000. We usually like to leave a little wiggle room in case there's some unexpected income that we didn't account for, or maybe their investment income is a little bit higher than what we projected. So for these extra RIF withdrawals, we choose the optimal amount of withholding tax to take off to optimize our client's refund or tax owing. We can take off as little as 10% at a minimum, or as high as 100%. So if we take out $30,000, we could easily send the whole $30,000 to the CRA, but typically that's not necessary and would end up with an unnecessary tax refund in the spring. Most of our clients prefer not to pay a large tax bill in the spring, so we usually look to withhold a little bit more than the minimum. Like in this scenario, we are withholding 30% tax, and we send that directly to the CRA to prepay their tax bill in the spring. For the most part, after we've sent a percentage of tax to the CRA, we typically keep the remainder invested by transferring in kind between their RIF account into their non-registered account or TFSAs if they still have contribution room available. So still the same strategies, but looking at the tax refund in the bottom line. So you can see scenario one, they owe about $4,000 in tax, but by withdrawing additional amounts out of the RIFs and using the optimal withholding tax percentage, they'll owe under $1,000 when they file in spring. Anything to add on that, Derek, before we move on?
Well, that moves perfectly into what I'm talking about next, which is why would you want to pay more tax now? And as you may have gathered from this, we're not wanting people to pay a lot more tax. We're trying to keep them in the same tax bracket that they're in. So if they're in the lowest tax bracket, we bring them up to the top end of the lowest tax bracket. If they're in the mid tax bracket, and or have old age security clawback concerns, we try and get them up to, but not over that. So you're not paying any more tax than you would. But the reason we're doing that is because, especially in the case of large RIFs or large capital gains, when one person dies, and it would be a lot easier if you could tell us the exact date that you're going to die, we could be a lot more advanced in our planning, but we don't know those things. So here's an example, sort of a scenario that we did for a client that one spouse had passed away. We'd done a good job of getting quite a bit of the RIF money out, but there was still a fair bit left. And so in this case, just doing the minimum RIF and counting on the regular life expectancy of this individual, without doing anything, they would have paid $11,000 over the next 3 or 4 years, but the tax on the estate would have been over $31,000, so they would have owed about $44,000 total tax bill over that time period. what we did was, just as Chelsea used in the last example, we took extra money out, bringing them up to the next tax bracket. So yes, they paid more income tax payable over the next 3 or 4 years, but we eliminated basically the tax on the estate because there was nothing left in the RIF. So what did we do? We saved them $10,000 of total tax payable. And we've been successful in many cases for clients. We have eliminated their RIFs. They have large tax-free savings account and a joint open account. So there is not a huge estate tax liability for them, because anything left in your RSP or RIF is fully taxable to your estate. So if you got $400,000 in an RSP or RIF and you're the last one to die, you get a T4 slip that says you earned $400,000 and you're going to pay about 50% of that in taxes. So that's why we would say it might be better to pay 20% or 30% as opposed to ultimately paying 40 or 50% tax on it. In addition, we try and do that because we have this benefit when there's a couple alive. Doesn't work so well with single people, but when there's a couple, you can use pension splitting. Because once one individual dies, you lose all of one old age security, you lose at least a portion of the CPP. If you have a company pension, typically you lose a part of that pension as well. A survivor is left with less family income, but nobody to split income with, and everything shows up on their tax return. They often go into a higher tax bracket. They've got less money in their hands and they owe more tax. So we're trying to avoid that as we go through that. So let's move into some try and finish up on some considerations before year end.
Yes.
So making charitable donations, preferably with appreciated securities. We've helped a number of clients do this. We review portfolios to see if there's any capital loss or capital gains that we should trigger. If you are needing some money, we look at potentially taking it out of your TFSA now, because then in January, anytime next year, you've got money, or we can move from your RIF or your open account back into the TFSA. If you have a child or grandchild, you can make RESP contributions. Doesn't save you any tax, but it diminishes the amount of taxable money you have in your hands. The RESP gets a grant. That has to be done by the end of December. If you're still working, you can contribute to an RSP. That one we've got until the end of February, beginning of March. That's the only tax deduction that's available after year end. For younger people starting out, and we have parents and grandparents helping their younger children or grandchildren, contributing to a first home savings account, which is a special account for first home buyers. That has to be done by December 31st, maximum $8,000 contribution. And of course, if you haven't maximized your tax-free savings account, get that money into your TFSA as quickly as possible. Chelsea will briefly go over just a couple details of each of these things that we've talked about.
Yeah, so most people know what a tax-free savings account is by now, but just briefly, you have to be 18. You can contribute up to $7,000 in 2025 to a TFSA. But if you haven't contributed all the previous years, you should have carry forward to contribute in addition to that. If you've never contributed to a TFSA before, as of this year, you could contribute $102,000 to one. Withdrawals are tax-free, of course. If you do withdrawal in the calendar year, you can recontribute whatever you withdrew in the following calendar year. And if you expect to need to withdraw from your TFSA, consider doing so before the end of the year, so prior to December 31st, because then if you run into some money, you could always replace what you withdrew in the next calendar year. First home savings account, it was introduced a couple years ago. Again, you have to be 18. You have to be planning to purchase your first home. You can contribute up to $8,000 a year. However, the contribution room does carry forward. So if you don't maximize the full $8,000 in 1 year, you can contribute whatever you didn't contribute the next year. Lifetime limit is $40,000. It's kind of a hybrid between a TFSA and an RSP, as the contributions are tax deductible like an RSP. However, when you withdraw down the road, it is a tax-free withdrawal as long as it's for a first home purchase. Withdrawing from an RSP or RIF. So this is what we walked through on our tax optimization process, but you may consider withdrawing from your RSP or RIF to bring your taxable income up to, but not over, the next lowest tax bracket. There is also a $2,000 pension income credit, like we talked about before. So if you're 65 and up, you may consider converting your RSP to a RIF early and withdrawing at least $2,000 to claim that $2,000 offsetting pension income credit. Another strategy, again, only if you're only 65 or older, if you have a lower income spouse, you may consider converting your RSP to a RIF to enable pension splitting with your spouse. Hey.
Okay, let's get into some changes. And the first thing, as you'll see on the next slide, budgets are given, but until they're passed and they've been finalized and the rules have all been given, don't hold your breath. In 2024, they brought out a budget that was going to change the capital gains inclusion rate. CRA went ahead and fixed all the tax programs and scared everybody. That budget never got finalized, it never got put into action, and so caused a whole lot of confusion. So all the things we're going to talk about that have been written in this recent budget may or may not come into be, or they may come into be with slight changes from what they are right now. The other thing that they didn't cancel, but bearer trusts, which is a whole nother story. They deferred the definition of what a bearer or reporting on bearer trust another year. They've now been doing that for 2 or 3 years. Who knows if they'll ever change it, but it's still on the books. They've just deferred it to another year. So let's see what happened in this year's budget. We've already talked about everybody will get basically about a $290 tax savings in 2025. And then if it goes through, as they've indicated, about a $580 per year tax savings for 2026 and beyond by lowering that lowest tax credit from 15% to 14%. However, the non-refundable credits will also get reduced to the new 14.5% and 14%. But rather than making things simple, what the government has done is they've got a top-up tax credit, whereas if you had made a charitable donation or you had other credits that you should have gotten the 15% on, but because of the new rules, they'll allow you to still get the 15% on those credits. So a little bit confusing, but worst case scenario, 15% is the lowest tax bracket for 2025. Also proposed, if you are a personal support worker, you might be eligible for temporary or refundable tax credit of 5% of your eligible earnings up to a maximum credit value of $1,100, slated to begin in 2026 for 5 years. So again, you have to be a qualified personal support worker. They haven't really defined what that is, and you would get a small credit. They have proposing to eliminate GST for home buyers on the first $1 million and reducing the GST on home prices between 1 and 1.5 million. They have also indicated the desire to have CRA automatically file your tax returns. Now, this wouldn't apply to everybody, mainly to low-income Canadians. They find that often a lot of low-income Canadians don't bother filing a tax return. They say, why bother? Because I don't have to pay taxes. So the intent is good, because oftentimes extra benefits and extra credits that could be paid to these people are based on your previous year's tax return. So if you don't file a tax return, you're missing out on some of your credits. So that's the idea behind it. That's a good thing. However, I really don't trust CRA with a whole lot of things and doing things on my behalf. We'll wait to see what happens with that. They do send you 90 days notice and saying you're eligible. We're going to do your tax return if you don't respond and say that you're going to do it. And you can also opt out of it, but we'll wait and see how that goes. They've also stopped the carbon tax rebate. They did drop the carbon tax on the retail end of it, so you won't be getting those carbon tax rebates on your returns anymore, or any checks from the government for that. And that wraps us up. Let's go to some questions, because we're just straight. Oh, we've got to finish up with all of our sources and disclaimers.
And now questions. So we are a minute away from our hour mark. So if you have to hop off, feel free to hop off now. And if you have any questions, you can always email us or contact us at a later time. However, if you do have any questions, please drop them in the chat function on Zoom, and we'll get to a few questions now.